Okay, let's try this one more time. One, I don't believe I gave a really good explanation of the solution to this comprehensive problem to help you understand the mechanics and the theory of what you're doing with the equity method of accounting for investments. Two, from a practical point of view, the recording I made disappeared. So I will do it again. Now, even though it's not required specifically on the requirements here, understand that a couple of things are happening. Number one, that as of January 1, 2014, Eagle, which I'll refer to as the parent company, acquires a 10% in Badger, which is the subsidiary. Because it doesn't meet the threshold of the equity method, the company does not have to use the equity method. And secondly, because there are no readily available markets values for the stock that is the investment by Eagle will be held at cost. And will simply be maintained at cost because there is no readily available fair market value if it's not traded. And so the choice of available for sale or trading securities is sort of irrelevant. The other issue that would occur then at the end of the year would be the recognition of dividend income. And since Badger declared a $110,000 dividend, Eagle, the parent company, would simply recognize the $11,000 of dividend income by debiting cash and crediting the dividend income. And that would be all that they would be required to do for the first year. Now, before we get at the mechanics here, understand what's happening in 2015. First, Eagle acquires the additional 30% of Badger, so that as of January 1st, 2015, Eagle owns a total of 40% of the equity or the common stock, if you will, of Badger Corporation. So Eagle has no choice. Under accounting rules, they must account for this investment under the equity method. Now, the other element that's required under GAAP is that they need to go back and make a retrospective adjustment to their investment account and assume that the equity method would have been used from the very beginning, that is, as of January 1, 2014. Now, be careful that in 2014, the company only owns 10%. So the 10% will be the percentage that will be applied both in determining if there's any goodwill and the amount of the dividend that would be recognized. As of January 1, 2015, now the company owns 40%. So 40% would be used in the calculations of income that will be recognized by Eagle, the amount of equity that they will assume that they have at that point. So the 40% is not used in 2015. Rather, 10% is used in 2014. 40% is used in 2015. We'll kind of skip through Part B right now. We'll come back to that with this issue of what do you do with inventory. So you'll see, for example, under the solution of Part A, that since they only own 10%, the stock is not actually traded. The investment is held at cost. The $11,000 is recognized as income. Now, in 2015, now some different rules began to apply. The process is twofold. First, Eagle must determine the amount of equity that they would have in the company as of the end of 2014 if they had used the equity method. Now, from the information they gave you, they paid $70,000. That's objective, no question about that. The book value of Badger is $600,000. Since they're acquiring 10% of that, since book value is essentially equal to the amount of equity they're purchasing $60,000 of equity. So they're paying over and above the amount of book value of $10,000. Now, the rules are pretty clear with accounting. Anytime you pay in excess of book value, you have to look to any particular assets which may be undervalued. And from a practical point of view, companies are pretty realistic. They're not going to pay more for a company than they need to. In this particular case, they've identified a specific asset that they believe objectively is undervalued by 100,000. Since they are requiring 10% of that, they can attribute that overpayment, if you will, to that specific asset. So the 70,000 represents the fact that really the book value of the company is 600,000, and that specific asset should be recorded at 100,000, or a total of 700,000. Goodwill is anything that would be left over after this excess up here is accounted for, and I can't attribute it to any specific asset. So goodwill is, in a sense, recognizing, as I said the other day, the expertise of management, the expertise of the employees that help you earn excess income over an extended period of time. All right, so what the solution is looking at here is what's happening as of the beginning of 2015. We know that we've attributed in 2014 what they paid, 70,000, that the excess of 10,000 is attributed to a specific piece of stock, or specific asset, excuse me. Now, in 2015, they go out and buy an additional 30%. Not 40, the 40% is what they have in total after this acquisition. So they pay 264,000. That was a given in here. We also know that as of the beginning of the year, that the total book value of the company is 700,000. So if they acquire 30% of that, the assumption is that they are acquiring $210,000 of book value. And as you can see from the calculation, they paid an excess of $54,000 over and above that. So the rules are that when you have this excess payment, that is the amount paid over the amount of book value that you are purchasing, you have to begin a process of attributing it to specific assets. And if there's anything left over, then it's deemed to be goodwill. Well, in this particular situation, they say, well, look, okay, we have this specific asset which has is undervalued by 80,000. Now, whether it's the same one up that we did in 2014 or another one, it really doesn't matter. If it's easier for you to think of it as a second asset, that's fine. But it's undervalued by $80,000. So at 30% of that, we can attribute part of that purchase price to the fact that both parties recognize that that specific asset is undervalued. So what we're left with here is the 30,000, which is the goodwill. Now, the rules are that if I contribute any excess payment to a specific asset, those assets will be amortized over their remaining life. And that amortization expense will be offset against whatever my portion of income would be from the subsidiary. Goodwill, on the other hand, is never amortized. Rather, each year, the company will examine it, that is, Eagle, the parent company, will examine the amount of goodwill that they purchased and make a decision if it has been impaired. If it's been impaired, then you write it down to its new value, and that then would be recognized as a loss. Goodwill is never amortized. Rather, it is considered to be impaired if it's lost value. Okay, now the objective of this problem is to determine what is the proper amount of the investment account that Eagle should have on this balance sheet reflecting its percentage equity in Badger. Now, we have to go back to this retroactive restatement so that as of in 2014, Badger reported net income of $210,000. 10% of that is $21,000. Now, here's kind of the tricky element you have to be careful of, the $2,000. That represents that excess payment that they paid, $10,000 over and above the book value, because they believe that the asset was seriously undervalued. And the total amount of the undervaluation was $100,000, and in 2014 they purchased 10% of that. So that $10,000 is going to be amortized over its remaining useful life of 5 years. So the 10,000 divided by 5 gives you $2,000 of essentially additional depreciation, but it's not called that. It's simply amortization that's used to offset, as you see here, the amount of income that the company will recognize, that is Eagle. That is, the equity in the investment income is the amount that will show up on their income statement. The portion, the 10% portion, less the amortization. So that amount would be recognized as income by Eagle. The investment account started with $70,000, namely what they paid for it, plus the $19,000 of income that they're recognizing, less the dividends that they received. Dividends always have the impact of reducing retained earnings. Since the equity method recognizes your portion of equity in a company, anytime the subsidiary, in this case Badger, is paying out a dividend, they're reducing their equity. So in a sense, I need to recognize a reduction in my investment account as well. The 10% of the $110,000, $11,000. So at the end of the year, 2014, the investment account would show a balance of $78,000. That's what you would then carry into 2015, when, starting at the beginning of 2015, they will now have a total investment of 40%. So this accounts for the restatement, the retroactive restatement, if you will, assuming that when you qualify under the equity method, you have to have comparable financial statements. So I need to go back and restate everything, assuming that the equity method was used from the beginning of the investment. Okay, now, as of the beginning of 2015, the company now owns 40% of the total stock or total equity of Badger. So they own 40% of the income of Badger. So 40% of the Badger's income of $250,000 is $100,000. However, you do need to adjust for the two elements of assets that you paid for, that go back to the $100,000 and the $80,000. That is $100,000 over 5 years gives you $2,000 of amortization. The $80,000 over 4 years gives you $6,000 of amortization. So in a sense, yes, we're bumping it up, but we're going to increase the amount of amortization or depreciation. And it's kind of on a side note. You'll see this a little bit later on when we look at international accounting standards, which allows you to bump up the value of an asset to its fair market value. But when you do that, you likewise need to increase the depreciation. So while we are recognizing an increased value of the equipment, we're also in a sense recognizing an increase in total expenses via amortization. So the amount of income that Eagle will pick up for the year is $92,000, $100,000 less the adjustment of $8,000. So the investment account, starting from last period, at the end of last year, $78,000, which you just calculated, plus the cost of the acquisition, what they paid for it. Again, that's always subjective, what you paid for it. The $92,000 we just calculated. And since the company, that is Badger, paid $100,000 of dividends, 40% of that belongs to Eagle, but dividends have the impact of reducing equity. So likewise, a receipt of a dividend or even the declaration of a dividend will reduce the amount of the investment account on the part of Eagle. So at the end of 2015, Eagle will show a balance in its investment account attributable to its investment in Badger Corporation of $394,000. All right, now we'll look at Part B. The first part of Part B is pretty straightforward, and that is many times companies don't pay a dividend at the end of each year. They may pay them quarterly, they may pay them semi-annually. In the case of Badger, they paid a $48,000 dividend, a $48,000 cash dividend. Actually, I'm sorry, it was a $120,000 dividend, and Eagle is entitled to 40% of that. So at the point of declaration, generally once a dividend is declared, it becomes a liability on the part of the declaring company. Eagle will recognize that they have a receivable, and likewise, they will go ahead and reduce the investment account by that amount. When the dividend is paid, debit the cash, and you credit dividends receivable. Again, the receipt of a dividend or even a declaration of a dividend by a subsidiary reduces your investment account under the equity method. Okay, now there are two things occurring that we need to recognize at the end of 2016 that Eagle needs to recognize. First, that Badger Corporation recognized $40,000 of $400,000 of income and $60,000 of other comprehensive income. And you have to separate out these two things. They're different. They show up differently in the company that earned them in their income statement, as I demonstrated the other day. Likewise, the company that is the parent, Eagle Corporation, needs to keep sort of a separate inventory of each of these types of income. Now, as far as the investment account is concerned, they're recognized, they're allowed to bump up the investment account by the total amount. You don't have to make a distinction in investment. So the 400,000 times 40%, the 60,000 times 40% gives you 160,024. So the investment account can be increased by the total amount of 184,000. No real distinction needs to be made there. However, when it comes to distinguishing the elements of the income statement, you have to make a distinction. First, the 160,000 will show up as its portion of Badger's net income. And so on the part of Eagle, that will show up as part of its calculation of net income. Badger also earns $60,000 of other comprehensive income. And we will have some examples of how that can be recognized a little bit later on. Principally by one that we talked about, if you classify an investment as available for sale, it increases in value, then that increase in value shows up as other comprehensive income. So let's assume the Badger has some investments. They classified as other comprehensive income. The fair market value of that increased by $60,000. Well, Eagle is allowed to recognize $24,000 of that, but it has to show up as part of Eagle's other comprehensive income, not as part of its net income. So the investment account is increased by the total amount, but you have to make this distinction here between these two different elements of the income, because they essentially branch off into two separate areas of the income statement. Likewise, too, we recognize again the amortization of the asset, the original asset of $800,000, the original asset of $80,000, how they're being amortized over 5 and 4 years, just like we did at the end of 2014. So the $8,000 will reduce the amount of Eagle's income, net income, and likewise it will reduce the amount of Eagle's investment account. All right. Now, the sale of inventory between a parent and subsidiary creates a little bit of a problem, also a little bit of a challenge, you might say. Eagle sold what cost them to either manufacture or to purchase $80,000 of inventory to Beagle or the Badger, and they marked it up by 20%, okay, or by $20,000. So they sold it for a total of $100,000. Now, before we get into specifics of calculation, the general rule under the equity method and consolidation is that you must eliminate all intercompany transactions. Now, essentially, the transfer of inventory really is kind of irrelevant. So, because from Eagle's point of view, you're just transferring it from one department to another. Now, Eagle would be allowed to recognize all of that income if Badger has sold all of it. But since Badger is holding some of the inventory, that is the $30,000 of it, okay, that $30,000 also has a certain amount of gross profit sitting in it that has not been sold to an outsider. So from Eagle's point of view, they're only allowed to recognize the total $20,000 when all of the inventory has been sold by Badger to an outsider. So the process here is to bring back or to adjust Eagle's income, if you will, by the amount of profit, gross profit, that is still in the inventory of Badger. And that's what we're going to look at here in just a second. Okay, now the gross profit here is 20%. Why? Because sitting in Badger's books, the amount is $100,000. It contains $20,000 of gross profit, so the amount is 20%. And the fact that there is $30,000 of inventory there, it means that you have $6,000 of gross profit that is sitting in the ending inventory. The $30,000 of inventory contains 20% of gross profit. The $20,000 over the sales price gives you the gross profit. So the amount that Eagle needs to adjust, not Badger, but Eagle, is to take the $6,000 of gross profit and recognize that because they own 40% of it, $2,400 of that needs to be reduced. So they're going to have to reduce their income by $2,400 and reduce their investment. They assumed that all of that was sold. It hasn't been sold. So the general rule is to always, always, always reduce the amount of profit that's sitting in an intercompany sale. All right, a couple of things are a little bit unusual with this transaction, which make it a little bit hard to understand. First, what they're doing is making a debit entry to essentially a revenue or income, okay, which is an unusual transaction. So what they're doing is by setting up the debit, when it's eventually sold, it will be recognized. And then likewise, too, by making a credit entry to the investment account, then when the total amount of income is shown, then those two things will be adjusted in the next year. In summary, the basic rule is that on the part of the parent company, they must always eliminate any sort of intercompany profit. That is, the profit that would have been recognized at $20,000 between the two different companies. And that profit, the total profit, can eventually be recognized, but only when it's sold to an outsider.